Welcome back to Accounting Journal Entries. In this video, we are going to show you how to read a balance sheet. A balance sheet is a financial statement that shows a company's assets, liabilities, and equity at a specific point in time. Assets are things that a company owns, such as cash, inventory, and equipment. Liabilities are things that a company owes, such as accounts payable and long-term debt. Equity is the difference between assets and liabilities. It represents the amount of money that the owners of the company have invested in the business. The balance sheet is divided into two sections, assets and liabilities. Assets are listed on the left-hand side of the balance sheet, and liabilities and equity are listed on the right-hand side. The two sides of the balance sheet must always balance, which means that the total assets must equal the total liabilities plus equity. Assets are typically listed in order of liquidity, which means how easily they can be converted into cash. The most liquid assets are listed first, followed by less liquid assets. Liabilities are typically listed in order of maturity, which means when they are due to be paid. The most current liabilities are listed first, followed by less current liabilities. Here is a closer look at the different types of assets and liabilities. Current assets. These are assets that are expected to be converted into cash within 1 year. Examples of current assets include cash, accounts receivable, inventory, and prepaid expenses. Long-term assets. These are assets that are expected to be used for more than 1 year. Examples of long-term assets include property, plant and equipment, intangible assets, and investments. Current liabilities. These are liabilities that are due to be paid within 1 year. Examples of current liabilities include accounts payable, accrued expenses, and short-term debt. Long-term liabilities. These are liabilities that are not due to be paid within 1 year. Examples of long-term liabilities include bonds payable, long-term notes payable, and lease obligations. Shareholders' equity. This is the amount of money that the owners of the company have invested in the business. It is calculated by subtracting liabilities from assets. By understanding how to read a balance sheet, you can gain a better understanding of a company's financial health. For example, you can use the balance sheet to determine how much cash a company has on hand, how much debt it has, and how much equity it has. You can also use the balance sheet to compare a company's financial health to its competitors and to industry standards. Thanks for watching.